A Credit Law Guide. Chapter 1. Credit Protection Laws. Credit Protection Introduction. Since 1968, credit protection laws have multiplied rapidly. The concepts of fair and equal credit have been written into laws that outlaw unfair discrimination in credit transactions, require that consumers be told the reason when credit is denied, let borrowers find out about their credit records and set up a way to settle billing disputes. Each law was meant to reduce the problems and confusion surrounding consumer credit which, as it became more widely used in our economy, also grew more complex. Together, these laws set a standard for how individuals are to be treated in their financial dealings. The laws say, for instance, that you cannot be turned down for a credit card just because you're a single woman. That you can limit your risk if a credit card is lost or stolen. That you can straighten out errors in your monthly bill without damage to your credit rating, and that you won't find credit shut off just because you have reached the age of 65. You must be aware. It is important to know your rights and how to use them. You have the right to know why a credit application is rejected. The creditor must give you the specific reasons. The credit reporting agency the creditor used is obligated to give you a free copy of your report. Have credit in your birth name, your spouse's last name or a combined name. Have a co-signer other than your spouse. Keep your own accounts after you change your name or marital status or retire unless the creditor has some evidence that you are unwilling to pay. Have credit jointly with your spouse. Books about credit are at number 332.024 at the library. To order free brochures on credit, contact American Express Co. Consumer Department. American Express Plaza, New York, New York 10004. AmericanExpress.com, exp.com. Free copy of booklet establishing credit. Federal Trade Commission. Public Reference Section. 6th and Pennsylvania Ave NW. Number 130. Washington, D.C. 20580. FTC.gov. 202-326-2222. The Electronic Fund Transfer Act/EFTA. The Electronic Fund Transfer Act gives consumers answers to several basic questions about using EFT services. A check is a piece of paper with information that authorizes a bank to withdraw a certain amount of money from one person's account and pay that amount to another person. A cancelled check is permanent proof that a payment has been made. Is proof of payment available with EFT services? The answer is yes. If you use an ATM to withdraw money or make deposits or a point-of-sale terminal to pay for a purchase, you can get a written receipt much like the sales receipt you get with a cash purchase showing the amount of the transfer, the date it was made and other information. This receipt is your record of transfers initiated at an electronic terminal. Your periodic bank statement must also show all electronic transfers to and from your account, including those made with debit cards, by a pre-authorized arrangement or under a telephone transfer plan. It will also name the party to whom payment has been made and show any fees for EFT services, or the total amount charged for account maintenance, and your opening and closing balances. Your monthly statement is proof of payment to another person, your record for tax or other purposes and your way of checking and reconciling EFT transactions with your bank balance. The way to report errors is somewhat different with EFT services than it is with credit cards, but, as with credit cards, financial institutions must investigate and correct promptly any EFT errors you report. If you believe there has been an error in an electronic fund transfer relating to your account, 1. Write or call your financial institution immediately if possible, but no later than 60 days from the date the first statement that you think shows an error was mailed to you. Give your name and account number and explain why you believe there is an error, what kind of error and the dollar amount and date in question. If you call, you may be asked to send this information in writing within 10 business days. 2. The financial institution must promptly investigate an error and resolve it within 45 days, however, if the financial institution takes longer than 10 business days to complete its investigation, generally it must put back into your account the amount in question while it finishes the investigation. The time periods are longer for POS debit card transactions and for any EFT transaction initiated outside the United States. In the meantime, you will have full use of the funds in question. 3. The financial institution must notify you of the results of its investigation. If there was an error, the institution must correct it promptly, for example, by making a recredit final. If it finds no error, the financial institution must explain in writing why it believes no error occurred and let you know that it has deducted any amount recredited during the investigation. You may ask for copies of documents relied on in the investigation. It's important to be aware of the potential risk in using an EFT card, which differs from the risk on a credit card. On lost or stolen credit cards, your loss is limited to $50 per card. On an EFT card, your liability for an unauthorized withdrawal can vary. Your loss is limited to $50 if you notify the financial institution within 2 business days after learning of loss or theft of your card or code. You could lose as much as $500 if you do not tell the card issuer within 2 business days after learning of the loss or theft. If you do not report an unauthorized transfer that appears on your statement within 60 days after the statement is mailed to you, you risk unlimited loss on transfers made after the 60-day period. That means you could lose all the money in your account plus your maximum overdraft line of credit. A financial institution may send you an EFT card that is valid for use only if you ask for one or to replace or renew an expiring card. The financial institution must also give you the following information about your rights and responsibilities. A notice of your liability in case the card is lost or stolen. A telephone number for reporting loss or theft of the card or an unauthorized transfer. A description of its error resolution procedures. The kinds of electronic fund transfers you may make and any limits on the frequency or dollar amounts of such transfers. Any charge by the institution for using EFT services. Your right to receive records of electronic fund transfers. How to stop payment of a pre-authorized transfer. The financial institution's liability to you for any failure to make or to stop transfers, and the conditions under which a financial institution will give information to third parties about your account. Generally, you must also get advance notice of any change in the account that would increase your costs or liability or limit transfers. A financial institution may send you a card you did not request only if the card is not valid for use. An unsolicited card can be validated only at your request and only after the institution makes sure that you are the person whose name is on the card. It must also be sent with instructions on how to dispose of an unwanted card. The EFT Act forbids a creditor from requiring you to repay a loan or other credit by EFT, except in the case of overdraft checking plans and, although your employer or a government agency can require you to receive your salary or a government benefit by electronic transfer, you have the right to choose the financial institution that will receive your funds. Fair Credit Reporting Act/FCRA. The FCRA protects consumers from unfair, harassing debt collection. If you've ever been billed for an unauthorized purchase on a credit card, your rights are protected under the Fair Credit Billing Act. The Act limits consumers' liability for unauthorized charges to $50, although many companies will waive this amount if consumers notify them of the dispute in a timely manner. The Fair Credit Reporting Act gives potential creditors the right to check out your credit with credit reporting agencies. Your file can be disclosed to the following if they have a legitimate reason. Anyone possibly granting you credit like a credit card company or a department store. Bill collectors. Insurance companies considering you for a policy. Government agency considering you for a business license. Someone conducting business with you like a landlord or a mortgage company. By subpoena or other court order. With the written permission by the consumer to whom it relates. For employment purposes. For assessing the risk associated with an existing credit obligation by a potential investor, servicer, or current insurer. For a legitimate business need in connection with a transaction that is initiated by the person whose credit report is being obtained. For a legitimate business need for the information to review an account to determine whether the consumer continues to meet the terms of the account. These entities can only legally obtain an individual's credit report if they have a permissible purpose under the Fair Credit Reporting Act, FCRA. In addition, the party obtaining the credit report may have legal obligations to the subject of the credit report, depending on how it is used. If the credit report is used to help make a negative employment or credit decision, the company who has done this must give the individual certain notices and disclosures. When an adverse credit decision is made in whole or in part on review of a credit report, the person whose credit report was obtained must be provided with notice of the adverse action, the name, address and toll-free phone number of the credit reporting agency that furnished the report, a statement informing the person that the credit reporting agency did not make the adverse action, and a statement that the person can obtain a free copy of his credit report by requesting it from the credit reporting agency. Criminal and civil charges could result from violating this law. If a company intentionally fails to follow any stipulations of the Fair Credit Reporting Act, it is liable to the individual for actual financial injuries that you suffer. Punitive damages awarded by the court. Court costs and attorney fees. Of course, you have to be knowledgeable enough to file suit and win in court. If a company negligently fails to follow any stipulations of the Fair Credit Reporting Act, it is liable to you for actual financial injuries that you suffer. Court costs and attorney fees. If anyone obtains information from a credit reporting agency under false pretenses, they are subject to criminal charges. You can obtain a free copy of your credit report once a year. If you need more, there is a fee structure outlined within the FCRA. You must request the free report within 60 days of the receipt of the denial of credit or employment. You can get information on the Fair Credit Reporting Act by going to the Federal Trade Commission's website, ftc.gov, clicking onto the Business button, then going to the Fair Credit Reporting Act area. The Fair Credit Reporting Act is located at 15 U.S.C. 1681, ETSEQ, FCRA 1681. FCRA websites: en.wikipedia.org/wiki/fair_credit_reporting_act, ftc.gov/os/statutes/FCRA, ftc.gov/os/statutes/050131fcra.pdf, ftc.gov/bcp/conlani/pub/credit/fcra.htm, ftc.gov/bcp/edu/pub/consumer/credit/cre27.pdf, federalreserve.gov/board-docs/submanual/cch/fairdebt.pdf. The Fair and Accurate Credit Transactions Act. The law requires merchants to scramble account numbers for all credit card and debit card receipts except for handwritten receipts or those made with an imprint of a credit card. Credit Bill of Rights. According to the Fair Credit Reporting Act and other laws, you have the following rights: to obtain your complete credit information from any credit bureau that has you on file, to dispute any information in your credit report or get missing data added, to have all potential creditors and employers who have inquired into your file during the past 2 years notified of errors that have been corrected, to put your side of the story on your credit file, to have detrimental credit information removed from your file after 7 years and bankruptcy information after 10 years. To keep your credit information private other than legitimate users of the information. To know exactly why you were refused credit. To have your credit report transferred from one city to another anytime you move. To use small claims court to resolve any disputes with your credit bureau about incorrect, inaccurate information in your file. The cost of credit. You get credit by promising to pay in the future for something you receive in the present. Credit is a convenience. It lets you charge a meal on your credit card, pay for an appliance on the installment plan, take out a loan to buy a house or pay for schooling or vacations. With credit, you can enjoy your purchase while you are paying for it, or you can make a purchase when you are lacking ready cash but there are strings attached to credit. It usually costs something and what is borrowed must be paid back. If you are thinking of borrowing or opening a credit account, your first step should be to figure out how much it will cost you and whether you can afford it. Then you should shop around for the best terms. 2 laws help you compare costs. Truth in lending requires creditors to give you certain basic information about the cost of buying on credit or taking out a loan. These disclosures can help you shop around for the best deal. Consumer leasing disclosures can help you compare the cost and terms of one lease with another and with the cost and terms of buying for cash or on credit. Credit costs vary. By remembering two terms, you can compare credit prices from different sources. Under Truth in Lending, the creditor must tell you in writing and before you sign any agreement the finance charge and the annual percentage rate. The finance charge is the total dollar amount you pay to use credit. It includes interest costs and other costs such as service charges and some credit-related insurance premiums. For example, borrowing $100 for a year might cost you $10 in interest. If there were also a service charge of $1, the finance charge would be $11. The annual percentage rate, APR, is the percentage cost, or relative cost, of credit on a yearly basis. This is your key to comparing costs regardless of the amount of credit or how long you have to repay it. Again, suppose you borrow $100 for 1 year and pay a finance charge of $10. If you can keep the entire $100 for the whole year and then pay back $110 at the end of the year, you are paying an APR of 10%, but if you repay the $100 and finance charge, a total of $110, in 12 equal monthly installments, you don't really get to use $100 for the whole year. In fact, you get to use less and less of that $100 each month. In this case, the $10 charge for credit amounts to an APR of 18%. All creditors, banks, stores, car dealers, credit card companies, finance companies, must state the cost of their credit in terms of the finance charge and the APR. Federal law does not set interest rates or other credit charges, but it does require their disclosures so that you can compare credit costs. The law says these two pieces of information must be shown to you before you sign a credit contract or before you use a credit card. Even when you understand the terms a creditor is offering, it's easy to underestimate the difference in dollars that different terms can make. Suppose you're buying something which you plan to make payments on. The lowest APR and the shorter the term, the cheaper it is. Other terms, such as the size of the down payment, will also make a difference. Be sure to look at all the terms before you make your choice. Cost of open-end credit. Open-end credit includes bank and department store credit cards, gasoline company cards, home equity lines and check overdraft accounts that let you write checks for more than your actual balance with the bank. Open-end credit can be used again and again, generally until you reach a certain prearranged borrowing limit. Truth in lending requires that open-end creditors tell you the terms of the credit plans so that you can shop and compare the costs involved. When you're shopping for an open-end plan, the APR you're told represents only the periodic rate that you will be charged figured on a yearly basis. A creditor that charges 1% interest each month would quote you an APR of 12%. Annual membership fees, transaction charges, and points are listed separately, they are not included in the APR. Keep this in mind and compare all the costs involved in the plans, not just the APR. Creditors must tell you when finance charges begin on your account so you know how much time you have to pay your bill before a finance charge is added. Creditors may give you a 25-day grace period to pay your balance in full before making you pay a finance charge. If you receive a credit card offer or an application, the creditor must give you information about the APR and other important terms of the plan at that time. Likewise, with a home equity plan, information must be given to you with an application. Truth in Lending Act. The Consumer Credit Protection Act of 1968, which launched the Truth in Lending Act, was a landmark piece of legislation. For the first time, creditors had to state the cost of borrowing in a common language so that you, the customer, could figure out exactly what the charges would be, compare costs and shop around for the credit deal best for you. The Truth in Lending Act requires creditors to give you certain basic information about the cost of buying on credit or taking out a loan, like the lending company name, size of loan/credit line, all charges, repayment schedule, minimum payments, Annual fees. Total payment. Length of grace period if any. Prepayment penalties if any. Late fees. Fees for credit insurance if any. Conditions for seizing your collateral in case you default on the loan. Lenders must disclose the true APR on your loan contract clearly with all loan costs included into the equation. Car title loans are regulated by the federal truth in lending laws that require a disclosure of the interest rate and the exact amount of the interest. Truth in lending does not set the rates or tell the creditor how to calculate finance charges, it only requires that the creditor tell you the method that it uses. You should ask for an explanation of any terms you don't understand. The Truth in Lending Act covers sections 1601 to 1615, 1631 to 1649, 1661 to 1667, 1671 to 1677, 1679, 1681, 1691 to 1693. law.ed/uscode/html/usc_1five/USC_01 Information the creditor can't use. The Equal Credit Opportunity Act does not guarantee that you will get credit. You must still pass the creditor's tests of creditworthiness, but the creditor must apply these tests fairly, impartially, and without discriminating against you on any of the following grounds: age, gender, marital status, race, color, religion, national origin. Because you receive public income such as veterans' benefits, welfare, or Social Security. Because you exercise your rights under federal credit laws such as filing a billing error notice with a creditor. This means that a creditor may not use any of those grounds as a reason to discourage you from applying for a loan, refuse you a loan if you qualify, or lend you money on terms different from those granted another person with similar income, expenses, credit history, and collateral. Age. In the past, many older persons have complained about being denied credit just because they were over a certain age. Or when they retired, they often found their credit suddenly cut off or reduced, so the law is very specific about how a person's age may be used in credit decisions. A creditor may ask your age, but if you are old enough to sign a binding contract, usually 18 or 21 years old depending on state law, a creditor may not turn you down or offer you less credit just because of your age. Ignore your retirement income in rating your application. Close your credit account or require you to reapply for it just because you reach a certain age or retire, or deny you credit or close your account because credit life insurance or other credit-related insurance is not available to persons your age. Creditors may score your age in a credit scoring system, but if you are 62 or older you must be given at least as many points for age as any person under 62. Because individuals' financial situations can change at different ages, the law lets creditors consider certain information related to age, such as how long until you retire or how long your income will continue. An older applicant might not qualify for a large loan with a 5% down payment on a risky venture, but might qualify for a smaller loan with a bigger down payment secured by good collateral. Remember that while declining income may be a handicap if you are older, you can usually offer a solid credit history to your advantage. The creditor has to look at all the facts and apply the usual standards of creditworthiness to your particular situation. Public assistance. You may not be denied credit just because you receive Social Security or public assistance, such as aid to families with dependent children. But, as is the case with age, certain information related to this source of income could clearly affect creditworthiness, so a creditor may consider such things as how old your dependents are, because you may lose benefits when they reach a certain age, or whether you will continue to meet the residency requirements for receiving benefits. This information helps the creditor determine the likelihood that your public assistance income will continue. Housing loans. The Equal Credit Opportunity Act covers your application for a mortgage or home improvement loan. It bans discrimination because of such characteristics as your race, color, gender, or because of the race or national origin of the people in the neighborhood where you live or want to buy your home. Nor may creditors use any appraisal of the value of the property that considers the race of the people in the neighborhood. In addition, you are entitled to receive a copy of an appraisal report that you paid for in connection with an application for credit if you make a written request for the report. Other aspects of credit. The best way to keep up your credit standing is to repay all debts on time, but there may be complications. To protect your credit rating, you should learn how to correct mistakes and misunderstandings that can tangle up your credit accounts. When there's a snag, first try to deal directly with the creditor. The credit laws can help you settle your complaints without a hassle. Never forget the possibility of identity theft already discussed. Truth in Lending gives you 3 days to change your mind about certain credit transactions that use your home as collateral. It also limits your risk on lost or stolen credit cards. Canceling a mortgage-backed loan. Truth in Lending gives you a chance to change your mind when you use your home as security for a credit transaction. For example, when you are financing a major repair or remodeling and use your home as security, you have 3 business days, usually after you sign a contract, to think about the transaction and to cancel it if you wish. The creditor must give you written notice of your right to cancel and, if you decide to cancel, you must notify the creditor in writing within the 3-day period. The creditor must then return all fees paid and cancel the security interest in your home. No contractor may start work on your home and no lender may pay you or the contractor until the 3 days are up. If you must have the credit immediately to meet a financial emergency, you may give up your right to cancel by providing a written explanation of the circumstances. The right to cancel, or right of rescission, was provided to protect you against hasty decisions or decisions made under pressure that might put your home at risk if you are unable to repay the loan. The law does not apply to a mortgage to finance the purchase of your home. For that, you commit yourself as soon as you sign the mortgage contract and, if you use your home to secure an open-end credit line, a home equity line, for instance, you have the right to cancel when you open the account or when your security interest or credit limit is increased. In the case of an increase, only the increase would be cancelled. Lost or stolen credit cards. If your wallet is stolen, your greatest cost may be inconvenience, because your liability on lost or stolen cards is limited under Truth in Lending. You do not have to pay for any unauthorized charges made after you notify the card company of loss or theft of your card, so keep a list of your credit card numbers and notify card issuers immediately if your card is lost or stolen. The most you will have to pay for unauthorized charges is $50 on each card, even if someone runs up several $100s worth of charges before you report a card missing. Unsolicited cards. It is illegal for card issuers to send you a credit card unless you ask for or agree to receive one. However, a card issuer may send, without your request, a new card to replace an expiring one. Credit law websites. bcsalliance.com/x_credit card tricks2.html, class action lawsuits filed against credit card companies. Cardreport.com, Consumer Credit Protection Laws. creditor-law.com. dol.gov, Compliance Assistance by Law, the Consumer Credit Protection Act, CCPA. en.wikipedia.org/wiki/consumer_credit_protection_act, Consumer Credit Protection Act. An employer cannot fire an employee just because his wages are garnished by a creditor. hsh.com/pamphlets/cons_handbook_credit.html, Federal Reserve's Guide to Consumer Credit Laws. law.cornell.edu/topics/consumer_credit.html. legalcreditexperts.com. repairmycreditnow.com/consumer_laws.htm. yourcredit.com.